welcome to the Q1 FY2024 earnings call of SBFC Finance Limited, hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Renish Bhuva from ICICI Securities. Thank you, and over to you, sir.
Yeah, thanks, Darwin. Hello, good evening all, and welcome to SBFC Q1 FY2024 earnings conference call. On behalf of ICICI Securities, I would like to thank SBFC team for giving us the opportunity to host this call. Today with us, we have the entire top management team of SBFC, represented by Mr. Aseem, MD and CEO, Mr. Mahesh, Chief Business Officer, Mr. Narayan, Chief Finance Officer, and Mr. Pankaj, Chief Risk Officer. I would now hand over the call to Mr. Aseem for opening remarks, and then we'll open the floor for Q&A. Over to you, Aseem.
Thank you, Renish, and good evening, ladies and gentlemen. Welcome to the first earnings call of SBFC Finance Limited. While for us, this call is a first experience post-listing. Most of you are veterans at this, and therefore on a lighter note, I request you to be a little more understanding if you make some beginner for participating in this call. We believe every business, if it has to have a license from society to survive generations, at its heart it has to have goodness in it. Profit cannot be the only purpose of its existence. We like to measure SBFC first by what it does for society. There are 4 pillars very dear to the institution that we are building. Pillar number 1, lot has been written about under-penetration of credit in India. We notice 2 Indias, one that is being chased by multiple financiers with open checkbooks, and the other that still continues to borrow at usurious rates of interest. The micro-enterprises of the small businesses are at the heart of this segment, and this quarter we are delighted to have served 18,874 such customers. Pillar number 2, Gandhiji told us India lives in its villages, but even after so many years of independence, we force those living in smaller towns to migrate to larger ones in search of basic opportunities. SBFC focuses on small businesses in small towns. Towards this, we opened 10 new branches this quarter, taking SBFC closer to where these small businesses are. Pillar number 3, what our country needs most are jobs, and not just ordinary jobs, but one that really develops skill and made it marketable. We realized that when one individual who did not get such opportunities be honed over time, we are contributing to lifting his family out of the rut of denials. SBFC has generated 314 new jobs this quarter, and we focus on hiring those that do not have a job yet, or at least not in the formal sector with PF and retirements, so that these families we have been blessed to impact. Pillar number 4, if God gives us the ability to generate profits through CSR, we are able to give a small part back and impact lives. This quarter, we focused on Sri Swaminarayan School in Manipura village in the Viramgam district of Gujarat, and a dilapidated school was remade. This impacted 117 existing school-going children, but the school was able to enroll 44 new girls that came because now the school has hygienic washroom facilities. Now that infrastructure has been done, we will try to improve educational delivery and create employment opportunities for the kids passing out of that school. We believe in the goodness of business. Every business has to have a heart and a head. I covered our heart and request Mahesh Dayani, Pankaj Poddar and Narayan Barasia to take you through the numbers highlights of this quarter. I would like to leave you with 2 things that have been a little different this quarter to help you with the context. As bankers, we're always uncomfortable accruing interest on an NPA asset, but in that, as you know, we had no choice. However, last year, we effectively stopped the interest meter after 12 months post-NPA. But this quarter, we have moved it to 90 days. This change meant that we had to reverse the entire interest accrued for these assets over 12 months and take a hit to our interest earnings. If you take this one-time hit out, our spreads and yields have actually improved. As you know, in our business, problems come from the unknown and unknowable, and hence it is prudent to provide for a rainy day, especially when you find yourself in bright sunshine as financial services is in India today. You don't really have to do this, but it is just that we can all sleep more comfortably at night. Secondly, we had an infusion of 150 crores of pre-IPO raise in the dying days of quarter 1. So you will have to keep that impact in mind while understanding our numbers. Over to you, Narayan.
Hi, good evening, ladies and gentlemen. I welcome you all in this first Concall of SBFC. As you would have seen the results and the presentations, the AUM of the company is 5,327 crore, which has grown at 47% on a year-on-year basis and 7.8% on a QOQ basis. Our MSME disbursement, which is our focus category, was about 655 crore for the quarter, which has grown at a 3.6% on a QOQ basis and 32% on a year-on-year basis. We have seen a sharp increase in the interest rate in FY23. However, we have been able to maintain the spread. The spread for FY22 was about 7.5% and around the same number throughout FY23. We, as the team was mentioning, we have stopped accruing the interest on the NPA account once it exceeds 90 days, and hence has to reverse about 6.2 crore in Q1. This is a one-time impact. Adjusting to this impact, the spread, which is reported as 7.09%, adjusting to the impact is about 7.63%. So in a way, the spread has been maintained throughout the cycle of the high interest rate. We continuously add branches in a small way. We added about 10 new branches in the quarter, and in all, we now have about 162 branches. The operating leverage of the company has been improving consistently. The OPEX to AUM ratio has come down from 6.09% in Q1 of last year to 5.42% in Q1 of this year. Our GNPA remains steady at 2.54%. Our total delinquency, which is 1+, has been steadily decreasing and stands at 5.51% of AUM. The credit cost is again steady at about 0.8%, which is also the number throughout FY23. We have reported a PAT of about 47 crore, which is an increase of about 10% on a QOQ basis and 46% on a year-on-year basis. The CRAR of the company as of 30th June is 33.5%, and the debt equity ratio is about 2.3. With that, the ROE, the return on tangible equity, is about 12% as of Q1 2023. We have sufficient liquidity in the company. We maintain a high PCR of 39.5% and also a substantial LCR, the liquidity coverage ratio in the company. With that, I open the call for questions and answers. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 if you wish to ask a question. We have the first question from the line of Renish Buva from ICICI Securities. Please go ahead.
Yeah, hi sir. Just sir, two questions. So one on the gross NPA side. So this quarter we have seen a marginal improvement on the gross NPA side. But if you could throw some light on the flow forwards given our 1+ DPD at 5%. So what is the fresh slippages for this quarter versus last quarter?
Yeah, so basically overall, if you look at our 0+ number or 1+ DPD percentage has been improving quarter on quarter for last few quarters, and the number stands as 5.5% as of June 23. We expect the number to stabilize and improve from here on, and overall on the GNP side also, the number has improved and is stable at now 2.54%. We expect this number to remain steady and improve. This leads to a credit cost of 80 basis points, which is what we have, which is a steady state number, and we expect this number to remain steady and range.
Okay. And so sequentially, what is the fresh slippages last quarter versus this quarter?
So in terms of value, if you look at it, is around 7 crores.
Sorry?
7 crores on the NPA side.
This is fresh slippages or net slippages?
Fresh net slippages is 6.5 crores.
Okay. Versus last quarter?
Last quarter was around 6 crores. Similar range. 6.2 crores.
6.2. Okay. So it's broadly flat sequentially.
Yes.
Got it. And sir, second question is on the growth side. So sequentially we have seen, a good growth, despite being the fact that Q1 is seasonally weak quarter. So would you like to throw some light on, let's say, which geography, which state is driving this growth, and how confident you are to sustain this kind of a growth rate going forward?
So if you look at our, distribution mix, our distribution is very largely evenly spread out between north, west, and south. And even if you probably look at the distribution mix to an average distribution split, they almost mirror almost 1/3 between all the zones. So the growth has been pretty even across all the zones. We don't really have a big concentration risk in any of those states. A single state doesn't constitute more than 17-18% as of now. So the growth that's come in the first quarter, what we've seen at 7.8, seems to be a sustainable number. We've always said is 5 to 7% is something that we are comfortable, turning around. And, we're hopeful that we'll continue with the trend moving forward as well.
Got it, sir. That's it from my side, sir. Thank you and best of luck.
Thank you.
Thank you. We have the next question from the line of Satadru Chakraborty from Chakraborty Family Office. Please go ahead.
Hello, good afternoon. My first question is from the presentation. There is a slide where you mentioned customers with greater than 100 CIBIL scores are almost 82.9. So I think I see the evolution of the graph. My question was, how many new to credit customers are you taking, and what sort of assessments are you doing to sort of increase the customer base overall?
So on the new to credit, the number is 7.8%, which is reflected as 0-1 score. And from a credit assessment standpoint, we have a localized credit model which is very, very specific to this segment. Over a period of last 5+ years, we have created the complete underwriting model starting from origination, which is in-house, where the salesperson goes, visits the customer. We have localized credit with a local understanding of the market as well as the collateral. And based on that, we have a dedicated team with the approval authority and supervisory structure at a state level, which basis which the origination is done. And based on the platform which we have created is on the LOS side. It's an in-house and co-origination platform which we have created, which it's a complete end-to-end workflow in which once the file comes to the local level, which typically today is in physical format, gets digitized, and then the entire workflow is digital.
Okay, very helpful. The second question I have, is on the borrowing mix. And I also see that has changed drastically between the first quarter of 2 financial years. My question really is not where the mix will be, but really what kind of yields and then what kind of, let's say, cost of borrowing can we expect? So is there any guidance that you can provide around these two aspects?
So we believe, given the macroeconomic picture, the interest rate in the market has peaked. And so is our cost of borrowing as well. We have already seen quite a sharp rate of interest increase, as repo has gone up by 250 basis points. The MCLRs have generally gone up in the range of about 170, 180 basis points. We have seen a slightly lower increase by about 140, 145 basis points. I think we believe the cost of borrowing should have peaked now, and if the macroeconomic picture turns out to be favorable, we will all get the benefit of the lower interest rate. But having said that, what we believe is the spread. What we control is the spread. So what we have done throughout this cycle is hold the spread. As you would see, the spread, which was about 7.5% prior to increase in the repo rate, is still maintained today at this level.
Okay, very helpful. Maybe just one quick question on the accounting piece as well. In the standalone financial results, can you give us a bit of flavor on what constitutes fees and commission income? Because I see this has drastically changed quarter on quarter, and I also see that the number is not insignificant for the last financial year.
Yes.
And what scope do you have to increase this or decrease this maybe?
Yes. So the fee and commission income essentially has a co-origination fee. So, you would have seen that there's a substantial business we do under co-origination program. It is in the range of 16-18% per month. And so there is a fee we charge to the co-origination partner, which is ICICI Bank in the given case. And then that is one fee which comes here. And then there are some other fees with respect to the initial money deposit we take from the customers to do the legal and other verification processes. We also get some fee income on the loan management service business, which we do. So all put together, these are the three important fees in this line item.
I remember seeing somehow that you mentioned that the co-origination business itself is increasing, and I just wanted to have a flavor on where do you think this can land in a steady state and what exactly are the strategy levers for this? Because I understand that the risk is minimized and so on and so forth.
Yeah, so currently, if you look at our co-origination total book is close to around 700 odd crores. This has taken us the last couple of years to start building on it. So at a disbursal level, it's close to around 18 to 20 odd %. At an AUM level, it is close to around 15%. We're pretty comfortable at the current run rate that we are at, which is close to around 18 to 20%. And we feel that moving forward, as the base also moves up in terms of our overall origination, the co-origination percentage will also be moving in that particular direction, and we'll be able to maintain at 18 to 20%.
Okay, very helpful. And maybe just the last question, if we can squeeze in. Is there any steady-state guidance which the company wants to provide for ROA and leverage, and therefore ROEs?
So, with the leverage which we are at today, our ROEs, and we also do an adjustment of the goodwill. So what we say is the return on tangible equity is about 12%. The capital base has increased because of IPO, so obviously the return on tangible equity will come down. But I think if you are able to maintain the spreads and continue with the growth, etc., the leverage will improve as we go along in future, and consequent to that, the return on tangible equity will as well improve. So we all wish that all the economies of scale, etc., and the growth continue, and then this number continues to improve as we go along.
Very helpful. Thank you, gentlemen, and all the very best.
Thank you.
Thank you. Participants who wish to ask questions may please press star 1. The next question is from the line of Amit Jain from Axis Capital. Please go ahead.
Yeah, hi, sir. Thanks for taking my question. So the first question pertains to your AUM mix. So what we see is that the MSME mix has increased from 74% to 81%. So what is leading to this, and do you see this further increasing to, say, closer to 90%, or do you have a specific AUM mix in mind?
No, so you're absolutely right. So, clearly SBFC is pretty synonymous with the MSME lending. And if you really look at our trajectory, the trajectory currently is 81% is MSME, close to around 15-16% is gold, and the balance is unsecured. Now, unsecured is one business that we vacated, and we're running it down. So clearly moving forward, you will see the MSME portion occupying a majority portion, whether it's 85 or 90, but if you just look at the number and the 3% actually, runs off. So by design, you will have a majority of the MSME holding the book. It's more looking like 85-15 when you don't have the unsecured, outstandings with you any longer.
Sure. And sir, secondly, again on the AUM, so this quarter we saw 47% AUM growth. So is it all like because of the the value terms, or is there an element of volume also in this? So have we seen an increase in ticket sizes? That is what probably I'm trying to ask.
Yeah, so I think the good part, if I probably break up the entire AUM and the disbursal, the good part is that we've always maintained that the MSME, which is a core of our business, the ticket sizes are going to be between 9 to 11 lakhs, and that's the ticket sizes that we would want to be in. In fact, in quarter one last year, our ticket sizes were 9.76 lakhs. The ticket sizes in this quarter, which is the June quarter, it's 9.84. This is marginally lower than the March quarter when it was 10.15. So the good part is that the volume growth is, close to around 32% on a year-on-year basis, and on a quarter basis, it's almost 7%. So that gives you a good sense that, it's just not, we're not looking at ticket sizes. We found a sweet spot between 9 to 11. So it's largely driven by volume, all of the AUM growth that you see on the MSME side.
Sure, that's helpful. And thirdly, on the disbursement side, so we saw a run rate of around 650 crores. So do you see this increasing further, or during the course of the year we can maintain this run rate?
Well, there has to be, some growth as we move along. We have invested in the distribution, over the last couple of years. As you would see, our distribution, we've added close to around from 135 to 162 branches in the last 1 year. That's close to around 27 branches. So there should be some disbursal growth that will come in, which should translate to, a more than 5 to 7% quarter-on-quarter AUM growth.
Sure. And any further plans to increase the branch addition? So you added 10 in this quarter. So any guidance you want to give for the remaining part of the year?
So we're pretty comfortable adding close to around 15 to 20 branches. We don't want to really go overboard in terms of adding branches. If you really look at probably our deck or the presentation, you'll see that we've added close to 27 branches in a year, and these branches obviously have cost us money, and they need to be profitable as well. So clearly we're not really in a hurry to be opening more number of branches unless and until the tail which is there is also equally profitable. So, but we would be pretty comfortable adding 15 to 20 and not more.
Sure. And sir, just one last question. So you mentioned something about 150 crores of pre-IPO expense or something. Could you just give some clarification on that? What was it?
So 150 crore was the pre-IPO equity which came in.
Okay. Sure. That's helpful, sir. Thank you.
Right. Thank you.
Thank you. To ask a question, ladies and gentlemen, you may please press star 1. Participants who wish to ask questions may press star and 1 at this time. We have the next question from the line of Rajesh Vora from Janmay Ventures. Please go ahead.
Yeah. Congrats on very good set of numbers, gentlemen. Asim, if you could give a little bit of idea about the kind of culture you have built and set up in this company, and what you have written a lot about HDFC Bank in the past, and how you are inculcating a great culture here, and how do you take this? You've zeroed on to SME side of lending, which is a tough part of the business. So how do you take it forward over the next 3-5 years would be wonderful to understand.
So the difficult part here is that culture is not what you lecture about. It is what you do, what you behave, and what you behave as an organization consistently translates into what ultimately gets delivered on the ground. So while it begins at the senior management level, it has to be felt at each level, at each branches and each locations. So we obviously no institution begins with an objective of creating a bad culture or a toxic culture, but there are certain behaviors that lead to it unknowingly. So what we try and do is ensure that we create a process where we have the right team all the way down the line. So not just at the senior management level, but at each level we have created the right team. We have focused enough on coaching the team, and bring them up to speed that everybody down the line is aware of what are the key deliverables of the organization, what kind of behavior the organization wishes to foster or not foster, and then create a culture of transparency, which is difficult to achieve, but one has to keep working and keep getting better at it. As we know in this business, there are 6-lane highways to hell and just one narrow pathway to heaven. It is a tough act, and we are still a young organization. We're just 6 years old. As the pressures of business mount as decades go by, to maintain this and to hold this is going to be the challenge. We still have a challenge of ensuring that our team, down the line, walks and talks the same path that you want them to talk. That you are fair to your customers. You are fair and transparent in your dealings with the customers. Give them a fair deal. Be transparent about costs, etc. Because in this business, some of these customers that we have lent to are used to paying much higher fees. So how do you ensure that you are doing it right? It is a process. We are trying our best to ensure that we are fair by the employees, we are fair by the customers, and we are fair by the society that we are a part of. So it is a part of it is what you attempt to do on a daily basis. Part of it is what you drive your processes in your organization back, and part of it is how you identify the behaviors that you like, and encourage that, and identify behaviors that you dislike, and discourage that. So it's a long journey, it's a long process. We cannot claim we have built any great culture yet, but we attempt and we keep attempting to get better at it over time.
That's very useful, Asim. And in this SME lending and between 5 lakh to 25 lakh that you focus on, what is the biggest one or two risk that your company, your credit team, underwriting team needs to focus daily and ensure that we don't get it wrong? Is there something you could give a little color on?
See, there are in any lending business, ultimately there are two things that you are looking at: the ability and the intention. And that is all your credit processes that you have are designed to try and fix out both of this. So what we have done is that we have built a model within the organization where there are every customer application, and there are 200 odd variables that are taken out of those applications, and they are mixed and matched, within the algorithm that we have written, and based on which we know the score that the customer application gets. And based on past behavior, and it's a learning model, so it's too young. We've only tested it on 60,000 applications yet. So the model keeps learning from itself over time, and unless it goes to 500,000 applications, you really don't have a model. So we'll keep working at it to hopefully get better, where we try and coordinate different variables in a particular application to arrive at a probability of default. And so far, at least the rankings that we have done are risk rankings. So far we seem to be on the right track, but we still have a reasonable way to go. The second risk that we have in this business is the life and health of the promoter and family. And that is something that most of our customers are not insured. So, we, in almost over 90% of the cases, we actually help them take insurance to ensure that if something happens to their life, the entire loan is covered, and they don't have to worry about the property, and their spouse is left with. It is a huge risk in there, and we don't want them inconvenienced, especially when the life has been tough on them with a tragedy. And second is the health of the promoter and spouse. That is really helped during the time of COVID. So effectively, what you do is that you ensure that you don't take in a customer who's over leveraged, you don't take in a customer who will struggle to pay the EMIs, and you don't take in a customer who is going to probably use that money to not put in the productive needs, and therefore create a pressure on them and us.
Interesting. Very useful, Asim. Thank you so much, and wish you and the team all the very best.
Thank you, sir.
Thank you. The next question is from the line of Amish Kanani from JM Financial PMS. Please go ahead.
Hi, sir. A couple of questions from my side. Sir, one, I just wanted to understand our comfort on our ratings, which, you said is recently upgraded to A+. The question is, sir, in the segment in which we are operating, do you think this rating is okay and we can have the right to, have the spread of, say, 7.5%, over and above our cost of funds for a long time, in the sense that we are comfortable with this rating? Question number one. Two, sir, I wanted to understand a little bit more about our co-origination model. If you can explain, is it return enhancing, dilutive? How do we look at ROE in that part of the business? And third, sir, I was curious about, private sector lending status for our business, whether, we have the benefit for full and, whether we sell those, credits and stuff like that, sir. Thanks.
Yes, so let me take the first question on rating. So see, credit rating has a camel's way of looking at a rating, and there's a very structured form of doing it. The organization has to keep on performing on different matrices to achieve, maintain a rating and to get a better rating. I think we are in that journey. I think over the last few years, I think we have been getting strengthened every year, and hence A+ happened to us. I think as we go along in future, obviously we would like to maintain and improve the credit rating. In terms of maintaining the performance as we go along in terms of growth, I think there's if you see one of the slides talks about the opportunity in the market. So opportunity is quite large, and I think we still don't feel that pricing will be a challenge when we talk about the growth. So I think rating is a function of not only the pricing but also the credit quality, the growth, the capital adequacy, and all other different matrices the camels talk about. Second question on co-origination, Mahesh will take it over.
Yeah. So the co-origination, the model is that 20% is with us and 80% is with the co-originating partner. While we don't call out the ROEs separately for the ME book and the ROEs for the co-originating book, but clearly by design, if you were to look at it, obviously the ROEs on the co-originating model is going to be substantially higher than what is there on the core ME book, largely because of two reasons. One, risk is largely on a pari passu basis. There's no FLDG, there's no income booking upfront. And obviously there is a book that's getting built and there is a trailing income that comes to us in terms of fee. So clearly it is profitable, and that's the reason why we've continued to maintain close to around 20% of our dispersal on a co-originating model. And moving forward, as we keep increasing this, it should probably enhance our overall profitability mix as well. The third part was related to your priority sector. Almost close to 79 to 80% of our customers on the MSME side qualify for priority sector. These are again classified as micro enterprises largely on the services side as per the RBI definition.
So in that context, do we earn the income out of selling those credits? And is that the other income that we accrue on by selling those say, do we create those PTCs and sell it back and stuff like that?
Yes. So we have done PTC securitization transactions as and when we require. We don't do it regularly, but yes, we have done that. So obviously the priority sector lending helps the organization. I think from a societal point of view as well as from a business point of view. Obviously, this is an opportunity from, as what you're saying, the capital raising point of view. And also, the priority sector lending is something which the development funds like a lot. So I think all in all, this is definitely an asset class which helps from a capital raising point of view.
Sure.
So to answer your question in a different way, and to give a little color, usually you would see NBFC securitize about 25% of their total assets. We think that co-origination is a better way to achieve that. So for what we are doing is that whatever we need to take it off books. We do it at the start itself and not take it and then sell down, which is actually, in my opinion, inefficient. So whatever we want to sell down, we will use PTCs and DAs as opportunities. We don't sell down priority sector assets, but as of now, we've not found the need yet. But if there is a market and if there is a shortfall and if we see that the yields we are getting are tempting enough, then we will look at it on a treasury basis, but not really as a business model.
Yes, sir, I got it. That's why that question, a combined question about co-origination. So because the guy we are tying up with anyway will need those kind of priority sectors, so we are doing it that way, as a clean and direct way is what you're saying. Got it, sir. Thanks a lot and all the best, sir.
Thank you. The next question is from the line of Ojaswi Kicha from PGIM India Mutual Fund. Please go ahead.
Yeah, hi. I have a couple of questions. First is if you could share your thoughts on how you would have chosen this 9 to 11 lakh ticket size. If you can share your thoughts there. And secondly, you mentioned bulk or entire growth is driven by volume, particularly this quarter. So what would be the new to credit customer mix for us? Yeah.
Yeah. So if you look at the total market size that we focused on, and that's also a part of our presentation, the total market size is, the total secured market size is close to around 8.5 lakh crores across various buckets. And if you look at a specific segment where SBFC is focusing on, which is 5 to 30 lakh, that's a 2.5 lakh crore market. And that's growing at roughly between 22 to 23 odd %, which effectively means that the market is doubling every 3 years or slightly above 3 years. Even if you look at probably the credit or the NPA numbers in that particular category, those are in the range of close to around 4 to 4.2%. This is based on the bureau data. So I think the growth is reasonable there. It's much better than what you see probably on the higher tickets where the competitive intensity is extremely high. Here you have supply arbitrage to some extent. So the runway for growth is significantly high on that side. And we felt that given the pan-India network that we've created, we have a significant room for growth as we move along.
And on the second question, new to credit is closer to 8% on the acquisition side.
So out of 650, so we disbursed 655 crores in quarter one, and of that 8% are the ones which were first-time credit.
Understood. Thank you.
Thank you. Participants, to ask a question, you may please press star and 1. Ladies and gentlemen, if you wish to ask a question, you may press star and 1 at this time. We have the next question from the line of Franklin Moraes from Equentis Wealth Advisory. Please go ahead.
Yeah, thanks for taking my question. So you've hit 1 lakh customers in this quarter, which is a significant milestone. Wanted to understand what is your next milestone and how long would it take to achieve that?
So the way the 1 lakh customers are split, close to around 40,000 customers are on the MSME side, close to around 60,000, slightly above that are on the gold, side. We add on the MSME side close to around 6,500 customers every quarter. And we're fairly comfortable in growing that run rate as we move along. So we don't want to clearly call out a number that we're going to hit 2 lakhs in this much period of time. We will stick with our guidance that we said that overall, volume growth or the value growth is pretty comfortable in the range of 5 to 7%, and we'll stick to that.
Yeah. Secondly, on the branch count, you shared that you would be comfortable adding 15 to 20 branches. Wanted to understand which are the regions that we are targeting, and secondly, what are your targets for OPEX to AUM?
So with respect to the branches, we are currently at 16 states, so we're not adding any further states. If you look at our construct, we are covering almost 25 to 30% of the total districts in a state. We will continue to invest in states which have matured. When we say matured in terms of origination, quality of origination that comes from those states, and also our profitability matrix. So the way we derive profitability matrix is as your branches age and how is your AUM moving in those particular branches. So we measure states on all the three performances right up to a PAT level and an ROE level. And based on that, we decide on the acquisition side. If I give you some sense, in the last 1 year, the 27 odd branches that we've added, most of the investments have gone into states like Bihar, Telangana, UP and Karnataka, and some part of it in North.
Yeah, thanks a lot.
Thank you. Ladies and gentlemen, if you wish to ask a question, you may press star and 1. As there are no further questions from the participants, I now hand the conference over to Mr. Aseem Dhruv for closing comments. Over to you, sir.
Thank you everyone for your time and patience listening. As you have studied so many finance businesses between banks and NBFCs, you have a comparative depth of understanding sometimes as practitioners we lack. Your questions will help us introspect and learn about areas that we can improve upon. Now our life is QSQP, or as they say, quarter se quarter tak. So see you next quarter. While fixing the call, we didn't realize it's Raksha Bandhan, and I'm especially appreciative of your taking the time out on this day. Wish you all a very happy Raksha Bandhan. With that, this is Team SBFC signing off. Thank you.
Thank you.
Thank you. On behalf of ICICI Securities, that concludes this conference. Thank you for joining us. You may now disconnect your lines.